The rapid rise of the People's Republic of China in the early decades of the 21st century represents a paradigm shift in the global affairs, comparable in the magnitude to the collapse of the Soviet Union. According to the World Bank, India and China had roughly similar GDPs in 1990, but China now has a far larger GDP of $14.5 trillion compared to India's $3 trillion GDP, indicating China's rise. China quickly became the world's second biggest economy, and many were predicting that it would overtake the US to become the biggest economy in the world as soon as in the year 2024. But we have a completely different take on this. The things we are going to discuss in today's video will blow your mind. The truth is, China's economy is collapsing, and it is an important topic for the world. To know more about the fall, we need to dig deep into the rise of the Chinese economy. Prior to the launch of economic reforms and trade liberalization nearly 40 years ago, China's policies kept the economy very poor, stagnant, centrally controlled, vastly inefficient, and relatively isolated from the global economy. To support rapid industrialization, the central government undertook large-scale investments. Private enterprises and foreign investment firms were generally barred. China had a huge labor force, but it was majorly uneducated and unskilled. The primary cause for such a high concentration of unskilled labor was Mao's demolition of schools and universities in order to crush the rebels. The Chinese government then decided to break with its Soviet-style economic policies by gradually reforming the economy according to the free market principles and opening up trade and investment with the West. Beginning in 1979, China launched several economic reforms, and since the introduction of economic reforms, China's economy has grown substantially faster than during the pre-reform period and, for the most part, has avoided major economic disasters. 1990s were the years when China started to create its dominance around the region. China joined the World Bank, the International Monetary Fund, and the Asian Development Bank. And in 2001, China joined the World Trade Organization. After China entered these international networks, it started doing what would make them the factory of the world. They began to replace Japan as a leading producer and distributor of goods around the world. And by the year 2010, China was the biggest exporter in the world. From 1979 to 2018, China's annual GDP averaged 9.5%, a pace described by the World Bank as the fastest sustained expansion by a major economy in history. China became the world's largest economy, manufacturer, merchandise trader, and holder of foreign exchange reserves. But, riding high on success, China didn't know that things were about to change. China's economy is slowing down as it adapts to a punishing zero-COVID strategy and weakening global demand. The country might not be battling steep inflation like the US and the UK, but it has other problems. The factory of the world has suddenly found few customers for its products, both domestically and internationally. Trade tensions between China and major economies such as the US and India are also hampering growth. The Chinese yuan is on course for its worst year in decades as it plummets against the US dollar. A weak currency spooks investors, fueling uncertainty in financial markets. All of this is happening at a time when President Xi Jinping has secured an unprecedented third term as the chief of Communist Party Congress and the president of China. So here's what's going wrong in China. China has the largest population in the world, where there are 37.17 million more males than females. China's official one-child policy was a huge factor in creating this imbalance, as millions of couples were determined that their child should be a son. This created a situation where there is a growing number of men that cannot find brides. It takes a house, money, and a good job to win a bride. If you want to find a bride, you need to have a house. This created an intense competition for brides, with men having to prove their material worth. This often means owning a home, and to do that, the entire families pour all their life savings in purchasing a house. Because the prices of apartments have gotten so out of control that according to the Financial Times, housing affordability in China is among the worst in the world. It would take the average earner 50 years to buy an apartment in China. The booming prices and limited availability of houses became an issue for the government. So they started issuing loans to property development companies as well as easing the credit lending standard to the people of China, due to which the Chinese real estate market skyrocketed and it fueled massive economic growth. Some companies like the infamous Evergrande took full advantage of the situation and expanded aggressively. Evergrande were earning so much money that they even built a theme park, purchased a soccer team, and entered the electric vehicle business with some of the money. Yes, just some of their money. Commercial housing sales reached $2.7 trillion in 2020. However, the supply of housing was still short because people started to purchase a second or third home as an investment, since it was considered as a wise use of savings. Seeing the never-ending demand, developers created an ingenious system to further fuel their expansion. The developers created a pre-sales option for buyers that quickly became popular in the country. Pre-sales means home buyers would give money to developers for a home that has yet to be built, and in return, they would get a promise that once it was finished, it would be theirs. The house construction would take around 2 to 3 years usually, and people will start paying their mortgage way before the completion of the project. The whole scheme quickly escalated with loose regulations and loopholes around how much money the property developers needed to keep. The developers started taking advantage by using the pre-sales money to start new projects without finishing the old ones. And once the new projects yielded new pre-sales, they would use some of that money to finance the actual project, while the rest of the money went to other new projects, and the cycle went on to continue. In simpler words, they created a Ponzi scheme that relied on the stable and booming growth of the housing market. However, once the interest of people to relocate to major cities started to slow down in 2020, the crazy scheme started to fall apart. With a lack of inflow of pre-sales, developers started to rely more on banks and foreign debt to keep expanding, and sometimes the debt was too large to pay with their operating income, so they used further debt to finance their obligations. It all continued for some time until the Chinese authorities saw the red flags and entered the scheme. In August 2020, in an effort to rein the highly indebted property development sector, the Chinese government introduced a 3 red lines rule to regulate the leverage taken on by developers, limiting their borrowing based on the following metrics: debt to cash, debt to equity, and debt to assets. Evergrande crossed all 3 lines, meaning that they were not able to increase their liabilities any further. And since Evergrande used debt to finance old liabilities, it was not long before they started to run into liquidity issues. And soon, Evergrande became the world's most indebted property group, having around $310 billion in liabilities. In March 2021, the company announced that it was looking to cut the debt load by $23.3 billion. Nevertheless, Evergrande was still expanding, having launched 63 new projects in the first half of 2021. By October 2021, 14 of China's 30 biggest developers had violated the regulation at least once. This resulted in a huge loss of confidence in the Chinese housing and bond market, both internally and externally, which led to the accumulated mortgage strikes by distinguished buyers, who were paying their monthly bills without seeing any progress on their property purchase. Chinese home buyers started boycotting mortgage payments in the middle of 2022. Data from a local site showed that home buyers were boycotting payments for 343 projects in mid-September 2022. This was an increase from 318 projects in early July. So this is how a once golden goose for the Chinese economy became one of the biggest setbacks for the Chinese markets. COVID outbreaks in several cities, including manufacturing hubs like Shenzhen and Tianjin, have been hurting economic activities across industries. Demand in countries like the US has declined too because of higher interest rates, inflation, and the war in Ukraine. More than 2 years into the pandemic, Beijing is sticking to its extreme approach to the virus with forced quarantines, mass mandatory testing, and snap lockdowns. Recently, Chinese authorities have announced a 7-day lockdown in the area around the world's largest iPhone factory, stoking concern that production will severely curtail ahead of Christmas period. Foxconn's plant in Zhengzhou, which employs about 200,000 people, produces the majority of Apple's new phones, including the new iPhone 14. Nearby cities have been drawn up plans to isolate migrant workers fleeing to their hometowns to prevent the spread of the virus. An official statement said that residents in the area were barred from leaving home and must be PCR tested once a day. Public transport services are suspended and only approved vehicles are allowed on the roads. Other measures include the closure of offices, non-essential shops and services. The statement said any violation of the rules would be severely dealt with by the police. Giving up on zero COVID doesn't seem like an option for President Xi, who this year has repeatedly put greater emphasis on defeating the virus than rescuing the economy. The clampdown of tech giants in China started in November 2020, when Ant Group, a fintech affiliate of Alibaba, saw its upcoming high-profile initial public offering in Shanghai and Hong Kong suspended by the regulators. In the following year, more tech companies in China became the targets of regulatory storm. Notable examples include Didi, China's biggest ride-hailing company, which had its app suspended for a suspected violation of cybersecurity laws, and Meituan, a major food delivery platform which became a target of an antitrust probe and was fined more than $530 million. But the question is, why did China crack down on its homegrown successful tech firms? The Common Prosperity Campaign, which emphasizes moderate wealth for all and encourages the wealthy to give back more to society, has become a defining theme of many policies after the Chinese President Xi Jinping's speech in 2021. The remarkable growth of the technology sector in China had exacerbated the problem of wealth inequality. The Chinese government wanted to put a brake on the expansion of the sector, which, according to some, was capturing 30% of China's GDP. It became a major concern that these companies might squeeze out smaller players and grab too much power, something that always irks the Chinese government. These enforcement actions sent a strong signal to the tech giants and the market that the Chinese government does not want to see too much power and wealth concentrated in a few hands. Investors have also sensed a clear signal that the government is willing to suffer significant costs to protect national interest and security. As state-owned companies appear to be gaining favor, foreign investors are taking money off the table. Japan's SoftBank pulled out a huge amount of cash from Alibaba, while Warren Buffett's Berkshire Hathaway is selling its stake in electric vehicle maker BYD. Until now, the people of China were ignorant about what China's communist regime was doing. Because there was prosperity, people were earning good money. But now, tens of thousands of young workers have lost work, adding to a job crisis where 1 in 5 people aged from 16 to 24 are unemployed. This is the time when they start questioning the government. Now, they want change, and this could ignite an internal rebellion in China that could hurt China's productivity and growth in the long run. China's population is on track to decline for the first time since the Great Famine of 1959 to 1961. The country's total fertility rate decreased from 2.6 in the late 1980s to just 1.15 in 2021. Researchers predict China's elderly population will overtake its working age population around 2080. Some are even predicting that it will happen sooner than we can imagine. Decrease in the number of working age people will lead to much lower economic growth and higher labor costs as the population shifts to care for its elderly. The world's biggest nation is about to shrink. At present, China has a lot in its basket, but only time will tell what will be the fate of China. What are your thoughts on the current situation of China? Tell us in the comments down below.